Every major economic collapse in modern history has one thing in common. The people who built generational wealth didn't panic when the crash arrived. They prepared for it years in advance. For decades, mainstream financial advice has repeated the same comforting story. Crashes are unpredictable. Diversification is your only protection, and trying to time the market is a fool's game. That narrative works reasonably well for the average investor. It was never designed to serve the other group. The ultra-high-net worth individuals and institutions whose actions tell a completely different story. They follow a different playbook, one that begins roughly 18 to 24 months before the crash becomes obvious to everyone else. Here are the 5 assets. 1 is technically available to anyone. Most people have never heard of it. And the 5th is the quiet mechanism through which wealth is legally transferred from the middle class to the ultra-wealthy during every major downturn. Asset 1, short duration, government paper. Cash is ammunition. It sounds boring. In the language of serious money, boring often means lethal. Before the dot-com bust, before the 2008 financial crisis, and before the 2020 COVID crash, a clear pattern showed up in the 13F filings of America's wealthiest investors. They weren't rushing into gold, real estate, or commodities. They were loading up on short-duration U.S. Treasury bills, 90-day sovereign instruments that yield barely more than a savings account. Warren Buffett's Berkshire Hathaway sat on over $130 billion in T-bills and cash equivalents by mid-2023, well before the regional banking turmoil. The financial conservative Even Ted was loading. The ultra-wealthy don't treat cash as an asset that costs them yield. They treat it as the only instrument that can be converted into every other asset class precisely when those assets are on sale at fire sale prices. During the 2008-2009 crash, the S&P 500 lost 57% from peak to trough. If you held $10 million in T-bills earning even 2%, you earned $200,000 while others lost half their wealth. More importantly, you had dry powder when extraordinary businesses were trading at half price. Knight Frank's wealth report documented a sharp rise in liquidity preference among ultra-high net worth individuals starting as early as 2006. They weren't hiding, they were positioning. Crashes require sellers, sellers require buyers, buyers require cash. The wealthy accumulate the one asset that cannot be destroyed by the very event they anticipate. Asset 2, distressed debt. The legal transfer mechanism. The second asset is one that conventional finance rarely explains clearly. Because if more people understood it, they would see that every major crisis is also a wealth transfer. When a company heads toward bankruptcy, its publicly traded bonds often collapse from 100 cents on the dollar to 15 or 20 cents. Panic selling drives prices to levels that price in total loss. Retail investors flee. Media writes obituaries. This is exactly when sophisticated capital moves in. Howard Marks of Oaktree Capital built a powerhouse firm largely on this strategy. His famous October 2008 memo remains required reading in finance programs. Distressed debt is not a gamble on survival. It is a legal mechanism to acquire ownership of a company's assets at a fraction of their replacement cost without paying equity prices. In bankruptcy, creditwaarvaardigheid, secured debt sits at the top. Equity holders are last and usually wiped out. Distressed debt buyers who purchased bonds at deep discounts often emerge as the new owners of the restructured company. During 2008-2009, distressed funds bought debt from automotive suppliers, commercial real estate trusts, and retailers. General Growth Properties, then America's second-largest mall operator, filed for bankruptcy in 2009 with bonds trading for pennies. Brookfield Asset Management accumulated positions in that paper. When GGP emerged from bankruptcy in 2010, Brookfield held controlling equity in a portfolio worth billions, acquired at a fraction of face value. Capgemini's World Wealth Report showed that high-net-worth individuals with exposure to alternative credit strategies outperformed standard portfolios by an average of 23% in the 3 years following the crisis. This mechanism is structurally difficult for retail investors to access due to regulation, minimums, and opacity, but the darker truth is simple. Every corporate bankruptcy represents both human hardship and the transfer of productive assets, factories, real estate, infrastructure, from dispersed shareholders to concentrated private capital at bargain prices. Asset 3. Productive agricultural land, the caloric floor. The third asset is the oldest store of value in human history, older than stocks, bonds, or central banks. It is currently being accumulated at a pace with no modern precedent. Productive agricultural land. Prime U.S. farmland appreciated over 500% between 2000 and 2020. It barely moved during the dot-com crash. Held steady through 2008 and actually gained 7% during the 2020 COVID shock, while REITs fell 40%. Why? Because land that produces food has a built-in floor. Human beings need calories regardless of monetary policy or financial system stress. Bill Gates became America's largest private farmland owner with roughly 270,000 acres across 18 states. The financial logic is ancient. In every major crisis, from ancient Rome to post-Black Death Europe to Weimar Germany, those with liquidity acquired farmland from distressed owners at fractions of prior value. The key distinction is productivity tied to global demand. Farmland linked to export crops with hard currency buyers retains real value even when local currencies collapse. It is not just dirt. It is a claim on future caloric necessity that transcends any single failing monetary system. Asset 4. Blue chip fine art. Scarcity that cannot be printed. For 6 months before major dislocations, something consistent happens in the private rooms of Sotheby's and Christie's. Private treaty sales, quiet. Direct transactions between collectors and buyers spike dramatically. This pattern repeated before 2000, before 2008, and before 2020. Blue chip fine art has near zero correlation to equity markets. A landmark study of 200 years of auction data showed that during the 57% S&P 500 decline in 2008-2009, the top segment of the art market fell only about 4%. The reason is structural scarcity. A Gerhard, Richter, or Picasso cannot be printed by a central bank. Supply is permanently fixed. The artist is dead. When fiat currency can expand by trillions in weeks, assets with truly inelastic supply become powerful stores of value. Private, treaty sales add opacity. During stress, more developed, descriptors appear in public indexes. For the ultra-wealthy, this discretion is not a bug, it's a feature. Capgemini reports consistently show investments of passion. Fine art, rare wine, classic cars rising to 5 to 10% of ultra-high net worth portfolios in the lead-up to financial stress. This is not sentiment. It is multi-generational pattern recognition wearing the disguise of passion. Asset 5. Essential service monopolies. The offense play. The first four assets are largely defensive, stores of value and preservation tools. The fifth is offense. It is how entirely new fortunes are built during collapses, in the 12 to 36 months after every major crisis. Private equity data shows a predictable surge in acquisitions of essential service businesses with inelastic demand. Waste management, self-storage, funeral services, pest control, water infrastructure, and medical waste. People still generate trash, need storage when downsizing, require pest control, and die regardless of GDP or unemployment rates. These businesses have stable revenues in downturns. Labor costs often fall. Smaller, leveraged competitors fail, allowing survivors to buy routes, contracts, and equipment at liquidation prices. Wayne Huizenga built waste management into a giant by acquiring distressed operators during the 1970s stagflation, not by innovating, but by owning the routes when others couldn't hold them. PitchBook data confirms the pattern post-2008. Acquisitions of these boring businesses accelerated sharply at depressed multiples, while their cash flows remained intact. The businesses everyone ignores during good times, unglamorous, no narrative, no speculative premium, become the highest return opportunities in bad times precisely because they were never overvalued to begin with. Closing. Every economic crash is not a random disaster. It is a predictable cyclical redistribution of capital. From the unprepared to the prepared, from the panicked to the patient. The middle class was taught that crashes happen to them. The data from SEC filings, wealth reports, auction records, and private equity flows tells a different story. Crashes are scheduled shopping events for those who know what to buy, why, and at what price. Cash is ammunition. Distressed debt is ownership in disguise. Farmland is a caloric claim on the future. Fine art is scarcity that cannot be printed. Essential service monopolies are permanent cash flows. None of this requires elite access to understand. It only requires the willingness to observe what the people actually building generational wealth are doing, not what they say in public. If the next crash is already casting visible holding, quiet art deals, farmland acquisitions, and distressed positioning, the only question that matters is, where do you want to be standing when it arrives?